Mitch on the Markets, a conversation about the issues and trends affecting investors with Mitch Zacks, Senior Portfolio Manager at Zacks Investment Management. Mitch, as new worries over some of the larger financial firms on Wall Street have surfaced now, does this give investors more of a reason to remain on the defensive, or are they beginning to look for opportunities?
I think we're closer to having the problems facing the financial services industry being resolved. There really is a problem right now with a major brokerage firm in terms of solvency, that the value of the assets is lower than the value of their total liabilities, and they're most likely insolvent, and the equity value there is really an option on that, a call option on the total value of the firm, effectively. But I think that what we're seeing is you're going to see probably some more activity, and when you finally see that final activity in this large financial service firm, you're probably going to start to see a bottoming occur in the financial services group. And I actually believe that financials will outperform going forward. They're still receiving an enormous number of downward earnings estimate revisions, so I will not be stepping up and buying them. I'd much rather be late and wrong, late and right than early and wrong, especially with the rebound in financial services. Right. But I think most of the bad news is out on the financial services side, and I expect to see a bottoming occur in that group that will start to help the market go higher effectively.
Some people took some looks at some recent economic reports that came out since we spoke last and had decided that they were negatives to the market.
The macroeconomic data is coming in about where you would expect it to come in for where we are in terms of the business cycle. And usually what happens is you're going to see the market start to respond positively while the economic news remains negative. And if we had not had another sort of leg down on the financial services group, you would have seen the market rally dramatically. What you're seeing right now is a little bit of fear in the marketplace, not a lot, but a little bit due to problems in the financial service group, and it really does represent a tremendous buying opportunity. The key to remember with equity investing is you know how the game ends. You know if you buy a diversified group of stocks and you hold it for a long period of time, they go up. And the question is, how fast do they go up and how soon do they go up? But you know how the game ends. So you take these pullbacks in equity valuations as really a buying opportunity to make sure your equity exposure is consistent with your risk level.
So the current economics don't concern you as far as a Fed rate cut by the end of the year?
The macroeconomic data is not going to turn before the market's going to turn. The market's going to turn way long before the macroeconomic data is going to turn. What concerns me is to make sure that the problems in the financial services group get resolved. You can't have this slow motion train wreck continue to occur, where you have problem after problem after problem, slight problems covering up by CEOs, and then slight more problems. We need to get the problems out in the open and get them resolved. They are going to get resolved, and once you have that resolution, remember, there were a couple issues at the beginning of the year. The two major ones were oil prices and problems on the credit side. Oil prices have come down dramatically. So that's the real problem to growth in the economy, is very, very high oil prices, very, very high commodity prices. That's no longer a problem. As soon as we get this issue with the financial services resolved, the market is very, very much going to be heading higher.
Now that you mention oil, I continue to ask that same question: how low can it go?
Well, you were asking 3 weeks ago. You were asking me how high can it go, and I said I thought it was going to go, and it was going to go lower. And I was surprised it kept moving up. And then there was some news that there was a hedge fund type vehicle that was essentially liquidating. You have to understand the problem with energy right now is that it has fallen into the hands of the financial services guys. And as they start losing money on mortgage-backed securities, they start speculating in the energy markets. I think that speculation is coming to a halt, and I think oil prices now are more accurately reflecting underlying economics and not having sort of a speculative premium to it. I think if oil prices come down, or even if they stay level, and you see some resolution on the financial service side, the market's going to have a very, very strong last quarter of the year.
So if I'm an investor and I'm sitting and trying to assess where to put my money right now, would I be looking at dividend-paying stocks? Would I be looking at emerging markets?
Dividend-paying stocks have done relatively well if you've avoided the financial service companies. So outside of the financial service companies, the primary payers of dividends are consumer staple stocks and utility stocks, and they've actually been performing very, very well. I expect that when the market turns, that extra alpha they generate is going to decrease somewhat. and I would expect to see growth stocks lead the rally going forward. I don't like international exposure. I've been trying to keep it at a minimum in client accounts at around 10 to 15% level, and I would not be buying international exposure on the dips. I would be buying U.S. equities on the dips, and I'm a firm believer that taking a little bit of risk in equities at this point in time is going to pay out very, very nicely over the next 8 to 9 months.
Okay. Time well spent with Mitch Zacks, Senior Portfolio Manager at Zacks Investment Management. With Mitch, I'm Terry Ruffalo.